Hey, what's up, stock compounders? Brad here. So Mohnish Pabrai gave his annual talk at Boston College just a few weeks ago on the Uber Cannibal investing framework. So I'm here to break this video down for you guys, both the Cannibal investment framework portion and the nuggets that Pabrai gave us in the Q&A portion of the talk. So let's dive right in here. He starts off with this quote from Charlie Munger: "Pay close attention to the cannibals, the businesses that are eating themselves by buying back their stock." Okay, and Pabrai has mentioned cannibals in the past. On his blog, he talks about the free lunch portfolio, and about a third of the free lunch portfolio is dedicated to these Uber cannibals, companies that are aggressively retiring their shares, buying back stock. So what's the Uber Cannibal investing framework? Essentially, Pabrai came up with a returns for cannibals, how you calculate what you're going to get back by investing in one of these companies aggressively buying back their own stock. So the formula is this: earnings growth times a buyback multiple times multiple expansion. Okay, most of you are probably familiar with earnings growth and kind of a price to earnings multiple for figuring out what returns might be. And there's a third factor that Pabrai threw into the mix here, and that's share buybacks. So the example he uses, he used a couple of examples, but the first one, the main one, was NVR, okay, a mid-Atlantic home builder. So the story of NVR is really a combination of incredible earnings growth over almost 3 decades and very aggressive share buybacks. They actually took a little hit on the multiple expansion. So what NVR was able to do was a 727 bagger, okay, over 28 and a half years. Over that time, they bought back 82% of their shares. So they only had 18% of the shares left after that stretch of time. So how we break it down for NVR: earnings growth 150x, okay, incredible, over almost 3 decades to increase earnings 150 times. Now, the buyback multiple was, the formula is 100 over the percentage of shares left, okay? So 100, in this case, 18% of the shares remained. They bought back 82% of the shares. So you have 100 over 18 for the multiple. That works out to 5.5. And the multiple expansion over that nearly 3 decades was 0.95. The earnings multiple actually came down a little bit. And that, aligns very closely with what the actual returns in the stock were. So there's some rules for buybacks, okay? You can't just willy-nilly buy back your own shares as a company and expect to create this massive value for shareholders. So I want to talk about what those rules are, and there's really three that really need to be paid attention to. The first is you need a stable or growing earnings over a couple decades, okay? And the target is really 2 decades. If your earnings are in decline, buying back your stock isn't going to create value for shareholders because the shareholders could have gotten paid out dividends from those earnings, right? That money could have been invested elsewhere. And yet it was put into retire shares, into basically a sinking ship. Okay, so you're really just throwing your money down the toilet when you're buying back shares of a declining business. And this was really the case for IBM, the case for Sears. Pabrai talks about these in this video. So that's the first rule. You need stable or growing earnings over at least a couple decades. So you really want to zoom in on businesses where you have confidence as an investor that the business is likely to grow or at least maintain its current earnings. The second rule, disciplined buybacks. Okay, you can't be buying back a very expensive company as compared to what the business is actually worth and expect to create value for shareholders. So the management needs to have discipline and the ability to come up with a reasonable intrinsic value for the business and only engage in buybacks when the price is below that value. So that's the second rule. Third rule, reasonable compensation. So this was interesting. I think it was NVR that Pabrai was talking about this, breaking it down about buybacks versus options exercises from management. Okay, so if the company is aggressively buying back stock, but it's also issuing shares to compensate management, you've got to know how to compare those and whether it's reasonable compensation of management or if it's just destroying value long-term for shareholders, if it's unreasonable, kind of egregious payment of management, compensation of management. So those are three things that are worth paying attention to when you're looking for one of these Uber cannibals. And kind of the punchline here, you can get spectacular returns even with, say, 15% consistent growers. Okay, a company that's growing earnings 15% per year consistently, that's a doubling of earnings every 5 years. It's easy to calculate that with the rule of 72. That means in 20 years, if you're doubling every 5 years, in 20 years, you've got a double, a 4x, an 8x, a 16x. Okay, so just the earnings growth is going to contribute 16x. And if you buy back 84% of your shares over those 20 years, that's going to take the 16x to 100x. Okay, so you can have a 100 bagger just with 15% annual earnings growth and pretty aggressive share buybacks over 2 decades, buying back 84% of the shares to get a 100 bagger in 20 years with no multiple re-rate, no earnings multiple change. So that's kind of, maybe a guideline about what to look for in these cannibals. Can a company grow earnings 15% a year consistently? And are they on track to buy back, 80 to 90% of their shares over those couple decades? Now, obviously, it's hard to project how many shares they're going to buy back, right? What percentage of their shares are going to be retired, because we don't know how the market is going to price the company. And if they're going to price it egregiously, well, the management isn't going to have the same opportunity to buy back their stock at reasonable prices. Of course, if it's priced egregiously, the multiple is going to go up. So, that could be just fine. But some things to consider with these Uber cannibals. Now, Pabrai talks about great candidates for Uber cannibals. He mentions ADP, Berkshire Hathaway, Microsoft, Alphabet, Amazon, Tencent. And right when he mentions Tencent, he says maybe not Tencent after what's happening in China just recently. At least Tencent 2 weeks ago, but it still might be okay. Okay, so, Pabrai is a little bit nervous about China all of a sudden. And there's been some speculation on other YouTube channels that might have been a clear sign that Pabrai has exited Prosus, which is his bet on Tencent. My sense is that he has not done that. I don't think he would buy today in China, but I don't necessarily think that he's exited as a result of what's happened politically recently. So just my 2 cents, right? No advice here. Henry Singleton. So Pabrai talks a lot about Henry Singleton in this presentation, the king of buybacks. I'm fascinated by Henry Singleton. So Singleton was not only a master of buybacks, he was actually a master of issuing shares to acquire businesses. Okay, so he was playing both sides very intelligently, which is really rare in a CEO. Normally CEOs really got the role as CEO because they're great salespeople, right? They're optimistic. They lead their team with confidence. And when you have that disposition as a CEO, you've got kind of rose-colored glasses on when it comes to the future of your business. And with those glasses, I think it's very hard to make calculated, rational decisions when it comes to, how to allocate capital, whether to plow it into growth, acquisitions, whether to buy back shares. It's pretty rare that a CEO can really master both sides of that. But Singleton really seems like he was able to do that. So he issued shares aggressively for acquisitions when Teledyne stock was flying high, acquired 130 companies at 10 times earnings with Teledyne stock when Teledyne traded between 40 and 70 times earnings, okay? Now, the shares outstanding quadrupled during this period from 1965 to 1970, okay? I imagine that would scare off a lot of investors to see the shares outstanding quadrupling. Now, in the next period, from 1972 to 1984, just the opposite. He bought back shares aggressively during this bear market when the shares were cheap, at least through the eyes of Henry Singleton. He bought 90% of Teledyne stock during that period. Okay, retired 90% of the shares. So that right there is a 10x in terms of the Cannibal return formula. All right, a 10x just from those share repurchases. Most of those buybacks were done through tender offers, bought back well beyond the earnings of Teledyne, okay? So Singleton is taking on debt to retire these shares. That could be perceived, I know a lot of investors that would perceive that as very risky, okay? But he did it and it worked splendidly well. Took on debt to buy back shares, later retired all the debt. So he really understood, okay, what is the risk of this debt that I'm taking on compared to what is the benefit of retiring these shares at market prices. He was able to very clearly see, yes, this is a path worth taking. So the key here is, can we buy back lots of stock at low multiples and end up with higher multiples and much higher earnings, okay? And there's a trade-off there. If you're gonna buy stock back aggressively, maybe it's gonna be harder to grow, right? Maybe it's gonna be harder to grow earnings because instead of using that capital, right, that's coming in above and beyond what it takes to maintain the business, you're buying back stock as opposed to plowing it into growth opportunities. So it's really interesting to think about those trade-offs and how you make those trade-offs in different market environments. And the magic starts happening when you buy back more than 80% of shares. So that formula, that would be 10 over 20%, which are the shares remaining, 5x. Okay, when you retire more than 80% of the shares, you're looking at 5x, 10x, 20x. The multiples get very compelling when you retire that much stock over a period of decades. And Pabrai puts out a table of companies over the last 10 years that have bought back the most stock. And that's interesting to look at, to try to see, okay, from those buybacks, was there value created for shareholders? Or was it really just a value destructive activity to be buying back that much stock? So that's really the meat of the talk. Now we're going to get into the Q&A. He's asked about interest rates and inflation. Okay, and I think in every Q&A he's asked about that. Pabrai says, because I'm looking for so much dislocation, interest rates and inflation are Mickey Mouse factors. Okay? They don't move the needle. When I want to buy something like Racis that I can buy at 3% of liquidation value, it's the example Pabrai loves to use probably for the last couple of years now. Interest rates and inflation, they're Mickey Mouse factors. They aren't on the order of magnitude as the dislocation, the opportunities that Pabrai is looking for. Now, he did mention Racis is probably a one in a lifetime investment opportunity. So, this is, I think, a little bit more theory than maybe fully practice. Pabrai saying, these things are Mickey Mouse factors. I'm sure they have a meaningful impact on, most of the investment opportunities that Pabrai is looking at. But the ideal is that they're Mickey Mouse factors. Ideally, we'd find opportunities where the discrepancy between price and value is so large that it just doesn't matter. He talks a bit about Amazon. The correct way to think about a business like Amazon is not even to think about intrinsic value. Okay? Strong statement there. If I were an investor in Amazon, the only question I would ask myself, is the business getting better? Okay? So that's one. The other question is the market pricing Amazon egregiously? Like, is it clearly, ridiculously priced? Not even remotely tied to what the business might be estimated to be worth. So those are the two questions. Now, he didn't really talk about what would you be looking at considering buying into Amazon. This is more if you're already an owner of Amazon. This is kind of the framework Pabrai would use to figure out to sell or not to sell. It'd be interesting to hear Pabrai's perspective on, how would you think about, is this a reasonable time to get into Amazon or not? Something he's talked about in previous talks, I don't even know how people can be investors without ever having run a business. And he likes to pull a Buffett quote from this. How can you teach a fish, tell a fish what it's like to walk on land, right? 100 years of describing what it's like to walk on land comes nowhere close to just a few minutes of actually walking on land. So you have the experience of running a business, right? And then you've got all these so-called investors who are trying to analyze a business through spreadsheets, right? And it's just, Pabrai doesn't see really how that's possible. You really need that experience of having run a business to be able to see the business through the eyes of a CEO, of a management team, to try to wrap your head around the business, what metrics actually matter in determining whether or not that business is successful 10 years, 20 years into the future. To some extent, it's not real for them looking at things through spreadsheets. This goes back to one of Pabrai's 10 commandments, thou shalt not use Excel. CEOs have 3 to 4 variables in their heads that drive 80% of the outcome. If you can get to the same variables that the CEO is using, then you've nailed it, okay? And that's really what investing is all about. Can I see this business through the eyes of the management team? What are the 3 to 4 things that really matter? And what is the trajectory of those 3 to 4 things over the next 10 years, 20 years? How predictable is that trajectory? Exceptional capital allocation requires a degree of rationality that most CEOs aren't capable of. And this is something I already touched on, so I won't beat this horse. There's two reasons most managers can't beat the index, okay? I thought this was insightful. He's talked about this before, but it's worth driving home. Because, I mean, what are we doing as active stock pickers if we're not going to beat the market? We should understand why the odds are stacked against us and how we can best position our own portfolios to transcend those odds. So two reasons most managers can't beat the index. One, the index doesn't have frictional costs, okay? The cost basis of, what is it, VVX or something, whatever, the low cost index fund tracking the S&P 500, it's like 4 basis points, okay? If we're buying and selling, very actively in our portfolio, we have much higher frictional costs than that. So that's one reason, frictional costs. Number two, this is the more interesting one to me. 4% of stocks deliver almost all of the returns in the S&P 500, okay? So out of the 500 companies in the S&P 500, what is that, 4%? That's 20. 20 stocks are responsible for basically all of the returns. All of the, positive returns. Anything over 0 is from 20 of those 500 companies. So, that's a tough game. Trying to pick the 1 in 20 winners, right? 19 and 20 aren't going to do anything for us. So that's tricky. That's a difficult game to play. And the index blindly holds this 4%, right? Blindly holds that 4%. Is too dumb to know when to sell, right? When Amazon seems too expensive, the index is too dumb to sell it. Active investors aren't, right? But if you look at the long-term track record of Amazon, it would have been dumb to sell it at basically any time, even after a run-up. It would have been much smarter just to hold. So that's why the index is so tough to beat. Pabrai says, I like the Baillie Gifford people a lot, even though I think they are overdosed on Carvana right now, okay? They aim to hold for a long time. And I'm going to link to this, guys. It's interesting looking at Baillie Gifford's holdings. They break out kind of how long they've held each of their holdings. And there's different colors to, denote whether it's been less than a year, I think like 2 to 5 years, 5 to 10 years. It's interesting to see, how many kind of long terms they hold in the portfolio and what returns those companies have generated. China. Given the leadership in China and given how they think about things, I would just not put a lot of energy behind China at this time, okay? I still like Tencent a lot as a business. I think Pony Ma is a once-in-a-generation manager. He may find a way to transcend all the headwinds and curveballs thrown at him. We'll have to see, okay? So again, Pabrai probably wouldn't be investing today in China, even after things have come down even further. My gut is that he hasn't sold Prosus. Okay, that's just my gut. And then I'll just throw this last one out there. This isn't from this talk. It's from another talk that Pabrai did recently, a little more under the radar talk, but it was a potent one. I think if someone really digested Poor Charlie's Almanac, it's better than most 4-year college degrees, okay? That is a powerful statement. Poor Charlie's Almanac it's kind of half biography of Munger, half talks that Charlie Munger has given. Pabrai's more interested in the second half of the book, the talks. But the book was edited. It was put together by a guy named Peter Kaufman. Now, you got Warren Buffett, right? Warren Buffett is fully in the spotlight. Everybody knows who Warren Buffett is. Then you've got Charlie Munger, right? Charlie Munger is maybe an order of magnitude less in the spotlight than Warren Buffett. You also have Peter Kaufman, okay? I'd say Peter Kaufman is another order of magnitude outside of the spotlight compared to Charlie Munger. So I encourage any of you guys and gals to dig into Peter Kaufman. He's got some really profound insights about how the world works, mental models, things like that. I mean, he compiled all of these mental models from Charlie Munger. He really drank from that fire hose of Charlie Munger's decades, nearly century of experience in business and investing. And it's pretty impressive, the messages that Kaufman has distilled. Check out, see if you can find any of his talks. I know there's one, I think it's just a podcast, it's just the audio. I'll link to it in the description. It's on SoundCloud. But that is well worth spending, I think, 45 minutes on and really digesting. So that's it, guys. I hope you enjoyed this summary of Pabrai's recent talk at Boston College. I've missed a bunch of talks, I know. I think there's like 6 or 7 since I made the last summary video of Pabrai's Q&A. But I'm getting back on it, guys. I'm getting back on the horse. The first rule of compounding is to not interrupt compounding, which I didn't stick to that one. But I'm going to get the engine back, the flywheel back up and running here. So appreciate your patience. Appreciate you for being back. And yeah, happy compounding. All right. See you guys.